Welcome to ETFatlas.com. I'm Jack Lampard, and today we have a very special guest who can help answer one of the most important questions facing individual investors. Should you focus on building a simple, let's say, boring portfolio, or try your hand at active trading? Rob Carver brings a unique perspective to this question because until 2013, he managed billions of dollars at AHL, one of the world's largest systematic hedge funds. But here's what makes him different. He is brutally honest about investing realities, and he wrote Smart Portfolios, a book specifically designed to help regular investors build sensible investment portfolios without getting caught up in the complexity of trading. So, Robert, welcome to ETF Atlas. I'm delighted to have you here as our guest.
I'm equally delighted to be on here. I do. It's nice to talk about ETFs than about investing for a change, because often when I'm doing things, I'm talking about trading. So it's nice to get back to this other area I don't get to talk about as much, definitely.
All right, so we'll touch a bit of trading as well later, but let's start with the big question that faces everyday people trying to manage their own money. And imagine our listener, let's call him Mr. Smith, and let's say that Mr. Smith has a full-time job in a profession which is completely unrelated to investing. Or maybe even let's imagine that Mr. Smith has retired and simply wants to look after his savings responsibly. And my question is, should someone like this even consider active investing or trading? Or is it maybe wiser, if we can say like this, to focus on the simple boring portfolio approach, which you lay out in Smart Portfolios book?
Yeah, I guess a boring portfolio. I mean, the most boring portfolio you could buy would probably be something like, you can get ETFs. You can buy a single ETF, or you can buy two ETFs, one that allocates to sort of a global stock portfolio index, like the MSCI World, for example, and then one that allocates to a boring bond index, and that's kind of, I guess, like ground zero for portfolios. And you can even buy them together in a single fund. So I think Vanguard, certainly in the UK, offer funds where you can buy a mixture of these things at the same time. So that should always be your baseline. Your baseline should always be, can I do better than just buying that? When I think about all the things that kind of would go into that decision making process. So one thing that's very much overlooked, I think, is a couple of different kinds of costs. So obviously, every time you buy and sell, you incur costs. So if you think you can do better and predict the future better than just holding this, as you say, boring portfolio, I very much like that term, by the way. I think I might write a book called The Boring Portfolio, assuming that someone hasn't already taken that name, because I think that's a great way of putting it. If you think you can predict the future well enough, you need to be able to do so well enough to overcome any trading costs that you might pay, and also potentially taxes on trading, and costs that would be taxes are being incurred potentially with things like capital gains, for example. Because obviously, if you're just allowing your funds to roll up over time, then you wouldn't necessarily generate any taxable capital gains. So that's the first kind of cost I think is often overlooked. The other cost that's really often overlooked, I think, is the cost of your time. So I think you have to kind of sort of look yourself in the mirror and say, well, okay. And the answer will depend on different people. And in some cases, it's very straightforward. So, for example, if, like me, you're self-employed and you charge out your time on an hourly basis, it's very easy to answer the question, how much is my time costing me? An economist would call this the opportunity cost, like the value of the time if you were spending it, say, poring over spreadsheets or charts on the internet or whatever it is you think you need to do to improve your returns. Alternatively, you could say, if you're in a sort of full-time job, you might say to yourself, well, this hour of my time, I could be spending it with my children or doing something I enjoy, like a hobby or something like that. Instead, I'm going to spend it in my investments. What sort of value do I put on that time for this alternative activity? And that might not be as high as your hourly pay rate, but you should still attach some value to your time. So then you need to say, well, let's say I value my time at, say, I don't know, $50 an hour, to pick a totally arbitrary figure. Can I realistically generate $50 more returns for that extra hour I'm spending on my investments? And if your portfolio is quite small, so if your portfolio is, say, $1,000, well, $50 is 5%. are you realistically going to be able to improve your portfolio returns by 5% by spending an hour on your investments? Almost certainly not, I would say. So that means it's probably not worth it from a, what we call an opportunity cost point of view. It's probably really not worth spending a lot of time on your portfolios over and above just buying the boring portfolio, unless you value your time very cheaply. And that might make sense. Like you may be weird and enjoy this stuff. I mean, I enjoy this stuff, right? I enjoy looking at spreadsheets and thinking about things and looking at investments and so on and so forth. So you could argue that my sort of opportunity cost is very low. But it would, someone who's earning minimum wage but also has a relatively big portfolio, well, yes, for them it might make sense for them to spend a lot of time on their portfolio. Now, how someone who's earning minimum wage can get a big portfolio is a different question, right? But for, if Mr. Smith is a relatively high earner, but their portfolio isn't that big yet, then it probably doesn't make any sense for them to spend a lot of time on their portfolio. Maybe when their portfolio is running into hundreds of thousands or even millions of dollars, and at that point you can say, well, actually my hourly rate's a very small percentage of that. So if I think I can spend, say, 10 hours and potentially improve my returns by 1%, which actually, to be honest, is quite difficult. Okay, 1% improvement is quite difficult to get. But then it may be worth doing that if that equation makes sense. So that's the starting point, I would say, is think about costs, both trading costs, but also the opportunity cost of spending time doing this stuff.
In your book, Smart Portfolios, you say that every investor needs to answer 3 fundamental questions. The first one is what to invest in. The second one, how much to invest. And then the third one, when to make changes in that portfolio. And maybe that sounds simple, but you've written extensively about why these decisions require careful thought. And could you please walk us through why this framework matters?
Well, yeah, I think it does, because I think a lot of people just think about buying and selling. They just sort of think, well, I need, what should I have in my portfolio today? And I haven't got that, so I need to go and sell everything I've got. I need to buy something else. And actually, that's not how you should think about things at all. So, in an ideal world, someone who's reading my book would be sort of starting from scratch and have a big pile of money they want to invest. And then they can think very slowly and carefully about exactly, I use what I call a top-down approach. So the first thing you do is think about how you allocate money into asset classes, and then so how much money in stocks, how much in bonds, how much in other asset classes, and then how much in US stocks, and then how much in US tech stocks, and then finally at some point you might get around to buying an individual stock, but not necessarily, because it may not make sense to do that. You might be better off just using ETFs if you can. So that's the ideal situation, but later in the book I sort of say, well, most people aren't in that situation. They probably already have a portfolio of stocks or bonds or ETFs. So what I say, well, what you've got to do is follow a careful process to sort of move from where you are to where you want to be. And in that process, you've got to think very carefully again about essentially, the potential rewards of doing this versus the costs of doing so. And the costs, again, primarily would be trading costs. But also possibly, if you're looking at ETFs, you obviously want to look at things like, expense ratios and other sort of maybe hidden costs of owning ETFs as well that people don't think about. So you've got to sort of say, well, yeah, maybe my ideal world, this is the portfolio I would own, but at the moment I have this. So what can I do to kind of get as close to that as possible? Because one thing I try and reinforce in my books is that often close enough is good enough. And we don't really know what the optimal portfolio is, right? Because we don't have a time machine. So we can create a theoretical optimal portfolio. But that's, it's unlikely that that will be the best in the future. And there are probably lots of other portfolios that are quite similar that will do just as well. So for example, don't get too kind of panicked if you think the optimal allocation to equities is 70%, but you've only got 65 or 75. That difference is almost certainly going to make no practical difference whatsoever. And you're not really going to know whether 70 really is the right number in the future, or whether a 65 is the right number, or 75 is the right number anyway. So you just don't know that. So don't get too caught up in getting exactly on 70%. And, don't, for example, then spend every day trading your portfolio to make sure that every day you hit that 70% number, because then your costs are going to be off the charts. And also going back to time, you'd be spending a lot of time on rebalancing that portfolio, which wouldn't necessarily make a lot of sense.
We're seeing massive growth in, I'm calling it passive, but maybe it's not a very precise definition, passive or maybe index-based investing. And some estimates suggest even that now it represents a huge portion of all equity investments. And my question is, what do you think about this trend toward everyone just buying the whole market through index funds and ETFs? Is there maybe a point where too much passive investing or too much index investing could actually cause us some problems for markets or individual investors?
I mean, I think there's almost two separate questions. One is like, as an individual investor, is index investing the right thing to do? And then, as you say, there's a broader, almost philosophical point about whether it makes sense to the market. So I'm going to address the first point first, I think, even though you actually said it second, I think. Sorry about that. The issue I have with index investor, well, let's talk about the benefits first. Most index-based ETFs are extraordinarily cheap. Okay, so they're very small expense ratios. And you're right to say is passive the right word, because of course you still have to do rebalancing trades when companies move in and out of indices. So that's why it's not quite passive. There is still a bit of trading that happens under the hood. But the main issue and problem I have is that when you're buying an index, of course, you're buying the index in whatever the weights are. And that means, for example, if you are buying MSCI World, which you'd think would be a very broad-based, global stock market index covering lots of countries and, with perhaps roughly equal weights to big markets like the US, Europe and Japan, actually that thing is heavily weighted towards US stocks and in turn heavily weighted towards US tech stocks. So you could argue that actually buying the MSCI World ETF is really like just buying Tesla, okay, or Apple or something like that, because it's going to have a very high correlation with those stocks because, US tech's a big component of that index. And so what you're basically saying by buying an index which overweights a particular stock is you're essentially expressing an opinion. And that opinion is, well, I think Tesla or Apple or whatever will outperform some arbitrary stock in, say, France that has a much smaller weight in the index, the global index. And the question is whether we really think that's likely to be true. Now, of course, it has been true over the last few years. The reason why these stocks are a big part of the index is because they have outperformed the rest of the market. They've outperformed the rest of the US market, and then the US market in turn has outperformed the rest of the world. So that's been true historically. The question is whether that's true in the future. Now, we do know that momentum, the trend following, if you like, is an investment strategy I actually use myself in my active trading. We know that kind of works well for sort of shorter time frames. So in other words, if something's been going up for the last few months, then statistically, we know it's probably going to continue going up. But if we look at multi-year horizons, then we're more likely to see mean reversion. In other words, if things have been going up, they're more likely to go down. So purely on that basis, you'd say, well, it looks like the stocks that have got really, really big in this world index are likely to fall back relative to other stocks, purely from a kind of statistical historical analysis. So on that basis, you'd say, well, actually buying index funds is completely insane because you're going to be putting more weight on things that have gone up in the past, which means that statistically they're likely to go down again in the future and do sort of mean reversion, as it's called. So, you could say, well, what we really ought to be doing was, well, let's assume we make no predictions about future returns at all. So we don't think things that we sort of say, well, we don't know whether things are going to go up or down. What should we buy? Well, we should buy, broadly speaking, an equally weighted index that has an equal allocation to pretty much every stock in the world. That's if that was available, that would be fantastic. But unfortunately, it's not. And it's certainly, where there are equally weighted index ETFs available, they tend to be more expensive than the ones for market cap weighted. And of course, one reason for that is that an equal weighted index cannot be passive at all because it's going to have to be constantly buying and selling to keep things at an equal weight. If something goes up, it'll be selling it and vice versa. And you can reduce those costs by clever rebalancing techniques and a bit of maths, but you're never going to get them down to the level of a market cap index. So I would say, generally speaking, if you can, and it depends on the amount of money you've got and the various trading costs you're potentially going to pay. But as a rule, I'd say if you can, if you've got the time, it's better to try and get closer to an equally weighted index, either through an ETF or potentially by doing it yourself by, say, one thing I advocate is something like buying, one stock in every sector, so in every industry in, say, the US. So then at least it's not something that's potentially tech heavy. Or at a country level, buying a set of country ETFs rather than buying a single global index ETF, because then at least you can say, well, instead of the weight in the US being 50%, I want it to be down to 25% or whatever level you think is reasonable. So that's for the individual investor. Now looking at the market as a whole, I mean, there's been a lot of debates about this in academic research, and one argument is, for example, that if there are very few active investors in the world, then the bad news is that prices are more likely to be wrong and stray away from what academics might call their fundamental value, because there just aren't enough people out there pushing prices back. And then we get bubbles generated where, let's take Tesla, because I think it's in a bubble personally, where that just ends up going up and up because there isn't anyone out there to enough people out there with enough money behind them to sell it short and bring the price down to sort of a reasonable fundamental value. Now, I'm not sure that we've kind of reached that point yet, but certainly it does feel to me like, and this is purely a kind of gut feeling, right? It's not supported by any evidence or scientific research, but it does feel to me like stocks have, moved further away from fundamental values than they have since, say, 2000. But then in 2000, there was a lot less passive indexing, and yet that bubble was still able to develop. So maybe this argument doesn't make a lot of sense. I don't know.
You advocate for portfolios that include not only stocks and bonds, but also some other asset classes like commodities, real estates, maybe international markets. Should regular investors consider other asset classes and how they can access these through ETFs?
Yeah, absolutely. So I'm a massive fan of diversification because I think that's something. I think one thing you can predict quite well is how correlated things are going to be, how they're going to move together. That's so, for example, if you look at stocks and bonds, then historically up till about 15, 20 years ago, they were negatively correlated. They were positively correlated. They tended to move mostly together, and that was because a lot of their returns were driven by interest rates and inflation. And then something changed and stocks and bonds became negatively correlated. And then a lot of people were advocating this so-called 60-40 portfolio where you basically store the same. Well, because stocks and bonds are negatively correlated, adding them together provides diversification. You can get a lot of safety benefit from that. Now, more recently, in the last few years, inflation has made a comeback, and with it, the correlation of stocks and bonds has gone up again. And that means that if you're looking for diversification, you have to look further afield. And one of the nice things about ETFs is there is a wide variety of things you can invest in using ETFs, everything from gold to Bitcoin to private equity to commodities, physical commodities. You can invest in ETFs that are based around the VIX index, the level of US volatility. So that means you're indirectly investing effectively in the options market. So there's a huge variety of things out there. Now, there are some caveats. One is cost. So again, these tend to be more expensive than just buying an S&P 500 or an MSCI World ETF index. The other is that they often have some hidden risks or dangers in them, some related to counterparty risk, others related to the sort of underlying volatility of the thing you're trading. So obviously, cryptocurrency is very volatile. The volatility index is very volatile. And in fact, a few years ago, there was quite a famous case where a volatility index, a short volatility index ETF went bust. So the investors in that got zero. So you've got to be a lot more careful and aware of what's going on than you would do with just a simple buying an equity index ETF. So it's not for everybody, but it's definitely a potentially valuable form of diversification in a world where, as I said, stock and bond diversification certainly isn't as good as it used to be.
You already mentioned about rebalancing our portfolios, and I wanted to go a bit further. When should regular investor rebalance the portfolio? I mean, should they do it on monthly, yearly, or maybe some other conditions basis? And how do they should do it in order to avoid paying too much, in transaction costs and also maybe in taxes?
Yeah, so a good way of reducing the cost of rebalancing is to do it less frequently. So I would say that any individual investor who's rebalancing, say, more than once a month, has got way too much time in their hands because, going back to my earlier comment about the cost of your time, you're not going to recover that by rebalancing once a month. You're also going to be incurring higher trading costs. Now, there is a way of getting around that, which is to use something called a buffered approach. And the idea there is you say, and this goes back to what I was saying earlier about not worrying too much if you want 70% in equities and you're actually at 65 or 75. So with a buffer, what you do is you actually formally say, well, I'm not going to do anything about my portfolio weights until they're wrong by more than X percent. And that X could be 10% or 20%. So, you might say, well, I'm not going to touch my equity, my simple equity bond portfolio, which is targeting 70% equities. I'm not even going to touch it unless the amount in equities goes down to, say, 60% or goes above 80%. And then at that point, I will rebalance. So it might be that you do that check every month, but you're unlikely to actually do more than 1 or 2 rebalancing trades a year unless we're in a very volatile period for the markets. You could, of course, also do your rebalancing, say, just once a year. So my kind of main ETF portfolio that I hold, actually, I only rebalance that once a year. And I actually do that just before the end of the tax year, because if going back to taxes, at that point, I kind of know what the gains and losses are on the individual investments, so I can take the appropriate action to optimize basically minimize the amount of tax I need to pay. I'm not going to give advice on how you should minimize tax, partly because it's different for every investor depending on where they live and the size of their portfolio, but also because it is quite complicated. And from memory in Smart Portfolios, I think I write about 20 pages on the subject. So, but the basic principles include things like, for example, don't do a trade just because of tax. So it's the other way around. You should be like, right, I want to do this trade. What are the tax implications? Oh, okay, the tax is going to be too high. Well, actually, is there another trade I can do which will give me a similar effect without generating as much tax? And this gets quite complicated if, like me, you've got some money that's in sort of tax sheltered accounts, and other money that's in other accounts. If, for example, you invest money on behalf of your spouse, which I do, then again you can potentially optimize things between accounts. So it can get very, very complicated. But the main principle I would say is firstly, do not just do a trade because it has a tax benefit. But secondly, always think about tax when you're trading, because it'd be stupid to pay a tax bill you don't need to pay, unless of course you love paying tax and you want to pay as much as possible. In which case, fair enough. That's a very good moral position to be in. But
yeah. When we talk about smart portfolios, or let's call them pie chart investing, everyone knows that they should just buy and hold. But it's simple to say, but not so easy to do. As Warren Buffett says, it's investing is simple but not easy. So my question is, how can investors build maybe kind of system to protect themselves from their own bad decisions and stay disciplined during these market ups and downs?
Well, it's very simple, really. All you need to do is have a plan and stick to it. Okay. End of question. No, seriousness. So I think the important thing when creating that plan is to understand your own kind of emotions and sort of vulnerabilities. So, for example, if you are someone who's quite risk averse and worried about downside in trading and losing money, then your initial set of investments should be created with that in mind. And that then makes it more likely that if you do start to lose money, that the losses will not be of a size where you panic, say, tear up your plan and do something completely different and just sell everything and panic. So I think that's really important. I think it's really important to have a plan and an initial portfolio that takes account of what your preferences are as an investor. It's much easier to stick to the plan if you know it's a plan, if you know the consequences of the plan and you're happy with them. So, for example, if you create a portfolio that's got a chance of losing, say, 10% in a day, which is perfectly plausible with like a leveraged ETF or a cryptocurrency, or even if you put all of your money into a single stock, you need to make sure that you are completely happy with that happening. Because if you're not, then you need to start with a different portfolio, and then it'll be much easier to stick to a plan that says, buy and hold, or don't change things. These are the portfolio weights we want to have. I will not change them unless the weights move outside of this region. And certainly almost no trading plan for investors should have a line that says something like, if you lose more than X, then panic and sell everything. That is not part of a plan that makes sense. So to avoid that, to avoid doing that kind of thing, to make sure you do stick to a plan that doesn't have that line in it, then make sure your initial portfolio is set up appropriately. You can go the whole hog like I do, and so one of my my sort of trading account is fully automated, and that means there's no possibility for me to kind of panic and change things without having to change a lot of code, and I'm not going to do that. But my ETF investing is done based on a plan that I follow, the sort of set up with my own understanding of risk and the amount of money I'm prepared to lose or not lose.
Yeah, I understand. Should investors diversify beyond the home countries? And if so, should they worry about currency risk when investing, let's say, in America? So let's say you're in the UK and you invest in the America or Asian markets through ETFs. Should you worry about this maybe currency risk?
So the answers are yes and maybe. So yes, I strongly believe you should diversify beyond your home country. And one of the great advantages of ETFs is they allow you to do that very easily, assuming that you're in a country that has ETFs listed for where you want to invest in, which isn't always possible, of course. So, and of course, those costs again. So if you're going to buy an ETF in a relatively illiquid market, it's probably going to cost more. And you do have to ask yourself if that extra diversification you're getting is going to be worth the likely higher fees that you'll be paying. But with all that in mind, then I would say, yes, definitely invest in ETFs overseas. Now, currency risk is an interesting question. So as ETF investors, we often have a choice between buying a hedged or an unhedged ETF. So, parochially, I'm a UK investor. If I want to buy the S&P 500, I can either buy a dollar-based ETF, which obviously is unhedged, or I can buy a sterling-based hedged ETF, which means that essentially I will not be exposed to changes in the currency, only to changes in the underlying index itself. And this is a classic example of that, because of course the S&P has gone up this year, but the dollar's weakened. And I'm not sure what the net figure is, but clearly this year you would have been better off. I would have been better off investing in a hedged ETF that was hedged against that risk. So the question, basically a question to ask yourself is how good you think you are at predicting the movement of currencies. And also to bear in mind, again, I keep coming back to it, but it really is so overlooked, and that's the thing, that's costs themselves. So if you're hedging, then that hedging is not a free thing. You have to pay to hedge. And that the cost of hedging will depend on things like the relative interest rates between the two countries. And also there's always usually additional cost on top of that as well, because hedging means you're doing FX trading. FX trading, again, isn't free. You're going to get charged for that. And you're going to get charged for the fact that someone's sitting in the ETF manager with a spreadsheet doing the hedging trade. You're going to pay for their time and so on and so forth. So it's not free hedging. So the question is whether you think that you are sufficiently worried about. So first of all, you have to say, can I predict what the pound dollar is going to do? Do I think that movement is likely to be large enough to overcome any costs of hedging? And if the answer to both those questions is yes, then yeah, you should hedge. For me personally, though, I'm not very good at predicting currencies. If I do want to predict currencies, then I have a more efficient way of doing that, which is that I trade futures, so I can predict currencies using those. And it's unlikely that the costs of hedging with an ETF are going to overcome, any potential benefit I could get from predicting. So I would say, as a rule of thumb, it's probably easier just to treat currencies as random walks that move up and move down. You can't really predict the direction. Live with the fact that will generate some years it'll be good, some years it'll be bad. And then you don't have to pay the hedging costs, which, as I said, can be quite expensive. And the other thing, and this is a sort of more subtle and technical point, is that if you hedge your foreign currency exposure, you'll reduce the amount of diversification you're getting in your portfolio. So that will, you'll actually, you'll actually end up increasing the risk of your portfolio, which is not what you want, rather than reducing it potentially if you hedge.
We're seeing now more, let's say, sophisticated ETFs like managed futures ETFs using behind, for example, trend following strategies. And this is the topic which is, I think, closer to you. You often talk about managed futures. And I wanted to ask, should maybe just a regular investor, Mr. Smith, consider this, or are they just expensive ways to complicate simple portfolios?
Well, again, it's costs and benefits. So, benefits are this is potentially a source of additional diversification. And there's in the past at least, and this is no guarantee of the future, but in the past at least, generally speaking, during sell-offs in major assets, managed futures has tended to outperform and do well. That's not always happened, and it may not happen in the future, but that's kind of one of the selling points for the asset class. So that's the benefit. The costs are that it's going to cost money because, again, any kind of anything that involves trading and requires people to do work to run it is going to attract a higher fee load than a simple passive ETF. And if that cost, for example, is 5% a year, then I'd say 100% you should not be touching this managed futures ETF with a barge pole, because it's extremely unlikely that you'll make sufficient money to justify your costs are much higher. If the cost was 0.5% a year, then I would say, well, maybe have a think about it, have a look at it. I do think, as a rule, people should have a very good understanding of things that they invest. And the more esoteric they are, the more that should be the case. And that's sort of, I think you should always understand what the risks of your investment are. And that may be as simple as looking at the historic price series and saying, well, what's the worst outcome that's happened? And that might be difficult for something like a managed futures ETF that's been launched quite recently. That might not show you how bad things can get. Although, luckily for you, the sort of drawdown in managed futures that seems to have finished a couple of months ago was certainly one of the biggest I've seen in the last 10 years. So maybe actually you can get a worst case scenario quite quickly. But yeah, I'd be sort of, again, it comes down to your own personal tolerance of risk. So don't put them in your portfolio if they fall when they fall 10%, you'll panic and sell them and buy something else, because they are going to fall 10%. They could fall 20%, because they're relatively volatile and that could happen. So be aware of the risks. Try and have at least some basic understanding of what they are and what they do and when they're likely to do well or badly. And if they're reasonably cheap, then yeah, maybe why not?
And can we say that managed futures ETF is just a simple way to access something what was delivered before by hedge funds?
Yeah, I mean, to get pedantic for a second, so a lot of managed futures managers don't like being called hedge funds, which is a bit weird because they are hedge funds really, but anyway. But yeah, so traditionally, I mean, if you go back 30, 40 years, then you would be paying fees of 5 and 20s. That means a 5% management fee plus a performance fee of 20%, and sometimes even higher. So you'd be paying a lot of money to access these funds. And now so certainly you can buy commoditized versions of these funds that are only charging a management fee, and a management fee that is sub 5%. And you could argue that that's maybe, certainly the managers would argue that that's not as good as the premium product that they still charge more for, although fees have come down across the industry. So you may not be exactly the same thing, but it's certainly going to give you a diversification benefit, because it's whatever it is, it's going to be different from buying stocks and bonds for sure.
Okay. What should regular investors expect from simple ETF portfolios in terms of returns over the long term? How do you help maybe people or investors set realistic expectations and prepare for volatility?
I think it's helpful to think in terms of Sharpe ratios. The Sharpe ratio is a risk-adjusted return. And technically speaking, when you calculate the Sharpe ratio, you should also deduct the sort of current level of interest rates. But for simplicity, it doesn't matter whether you do or don't, because you could argue it's going to be hard to predict interest rates in the future. So just include them as part of the calculation. So if you look at, say, the last 20, 30 years, then Sharpe ratios in most asset classes have been around 0.4. And it's actually remarkable how consistent. I'm writing another book at the moment and literally have a graph showing, cryptocurrency Sharpe ratio 0.4, about, so between 0.35 and 0.45, cryptocurrency 0.4, bonds 0.4, stocks 0.4, even leveraged ETFs 0.4, because basically the leverage and the extra return are exactly offsetting. So it's quite remarkable that sort of finding. I would say for starters that 0.4 is probably optimistic going forward, because returns have been relatively high over the last 10, 20, 30 years. Use a different number, maybe 0.3, maybe 0.25 potentially. And then it's quite a simple calculation. You say, well, how risky is the thing I'm trading? And you multiply the Sharpe ratio by the risk, and that tells you, roughly speaking, what in the long run you could expect. So, for example, let's use 0.333 recurring, because it's the same as a third, makes the maths easier. So let's say you think that the risk in, say, stocks is going to be about 18% a year, which is kind of a rough figure of what it's been roughly. And that's for a stock index, by the way. That's not for an individual stock. It'd be higher on individual stocks. Well, 18 multiplied by 0.3 recurring is 6%. So 6% a year for stocks seems a reasonable figure. In bonds, that risk is more like 9%. So it'd be 9% divided by 3, which is 3% a year. And that's going to be for sort of an 8 to 10 year duration bond. It'll be lower for short durations and higher for longer durations. It'll be higher for corporate bonds. It'll be higher for emerging market bonds, and so on. So you can do this sort of simple calculations, and that I think gives you a more realistic expectation than just, say, looking at the last few years and saying, well, hey, the S&P has gone up by 250%, therefore it's going to continue doing that. Or even worse, looking at Bitcoin and saying, well, Bitcoin's gone from $100 to $100,000 in sort of 15 years. Well, it's going to do that again. It's going to go up by a factor of 100 again. A factor of 1,000 again. That again seems unlikely to repeat itself. So I think using a kind of this quite crude technique is quite a good way of getting maybe slightly conservative but realistic expectations of what you can expect going forward.
So we have covered so far the topics you described in your book, The Smart Portfolios. And I wanted to move a bit further because you're a professional trader, and I wanted to ask, at what point maybe someone consider moving beyond basic ETF portfolios, and what are maybe some of the prerequisites for more sophisticated approaches, and how can people honestly assess whether they're ready for it?
I mean, the first thing to say is I don't consider myself a professional trader because no one pays me to trade.
But you used to be.
I used to be, yeah, a long time ago now. What do you mean by more sophisticated approach? Do you mean still investing in ETFs but buying and selling more, so trading more often, or
maybe some tactical asset allocation, for example?
Sure. Understood. So again, it comes down to whether you can think you can add value and whether it's worth your time. Something like a simple. So there are two basic models I introduce in the book to sort of how you could start doing asset allocation, by which I'm dynamically changing your portfolio weight. So rather than, let's go back to a simple bonds and equities example, rather than saying, well, 70% equities, 30% bonds, saying, well, actually, in certain situations, you might want to go more into equities and lower into bonds, and vice versa. So a couple of different models introduced. One is momentum. So the idea is that you look historically at the performance of assets, and if, say, the last 6 months to a year, equities have done better than bonds, and put more into equities and vice versa. And then another thing that tends to work better, like within asset classes, is something like a dividend yield model. So there you'd put more money into, say, I don't know, Norwegian ETFs because they've got a higher dividend than, say, US ETFs in stocks, which I think is true, but I'm not sure. So those are the sorts of simple models you can do, and they're really simple. I mean, so you're literally talking about putting a few numbers into a spreadsheet. So it takes a few minutes every time you think about rebalancing your portfolio. So if you're rebalancing once a year, then it's really not a lot of extra workload. I think obviously you will generate trading costs from doing that, and you need to be aware of what they are. So I'd say that when you start moving, so I don't know where the borderline is between investing and trading. So is rebalancing your portfolio once a year using tactical asset allocation, is that now trading? I don't know. Is doing it once a month trading? Sounds a bit more tradery to me, but people say, "Oh no, I'm still an investor." I'm not a trader. So I don't know. Doing it every second, probably you're a trader then at that point. So somewhere in that region is the boundary. But I'd say, the more you move towards trading and rebalancing at a higher frequency, definitely the more you need to be aware of potentially what your costs are and have a really good understanding of those. The benefits you're likely to get from more of a tactical rebalancing are not that big if you do it right. Because what you shouldn't be doing is going from 70% equities down to 0 or up to 100. There's just not enough statistical evidence that that's what you should be doing. And maybe that's the difference, because a trader would do that, right? So that's so you're not going to be making big swings. You might be moving your equity allocation from 50 to 90, for example. So that is going to make some improvement to your returns, but it's not going to be massive. That also means, of course, if you're wrong, is that the downside of doing this isn't that big, which is fine. So it's all about an incremental gain you might get. The question is whether that incremental gain is worth trading costs and extra time. So again, I'd probably say the bigger your portfolio is, the more likely you are to benefit from doing this. At this level, it's not really about needing any special insight or skills or knowledge, I'd say, if you're just following simple tactical asset allocation rules of the type I described. Obviously, if you are going to do something more complicated than that, then you are going to need some kind of special skills or insight and experience as well, because a lot of people think they can make money trading, but most of them can't.
Could you please explain in everyday terms why humans are naturally terrible at investing? I mean, what specific mental mistakes cause the most financial damage?
Well, it's because we're emotional, right? So if going back to what I was saying earlier about making a plan and sticking to it, the reason that's not going to happen is because when we see a loss in our portfolio that's bigger than we expected or we can cope with, then we experience emotions of panic. And alternatively, if we think we can make large returns by investing in a risky asset, we get greedy without thinking rationally about whether that's the right thing to do. So it's those emotions that drive poor decision making and make us do things like, for example, if a stock's gone up by a little bit, take profits early. Things have gone down, then don't cut your losses. That's why trend following seems to work. It's because people don't like doing the opposite. They don't like holding on to gains and cutting losses. A lot of people find that hard to do because emotionally it's difficult. Emotionally, you're always thinking, well, I've made £100. I should just put that in the bank, right? I just close this position. Or thinking, well, I've lost £100, but it's not a real loss until I actually close it. I'm going to just hang on and hope it comes back. And that it's weird. You basically your mind treats gains and losses differently. You make a gain and you treat it. You treat it as a unrealized gain. You want it to be money in the bank, so you close it. You make a loss. You basically say, well, it's not a real loss. Until I actually close it, and then it crystallizes. So I'm going to hang on and hope it stops being a loss and becomes a profit. So that's a wholly irrational way of thinking. And of course, no computer is going to do that if it's been programmed properly.
Yeah. Okay. So now let's shift gears for our, let's say, more curious listeners who want to understand what systematic trading actually looks like in practice. And Rob, I wanted to ask, how much time do you actually spend each day managing your own systematic trading portfolio? Is it hours of analysis per day, or maybe it's like checking your email?
It's like checking my email. So basically, most days I basically look at a couple of emails. One tells me if something's gone wrong. So it basically says here is a process that should have run and hasn't run, and that might be perfectly logical because maybe there's been a market holiday, so I've not been able to get prices on a particular market for that day. But it could be a more serious indication. And then the other email basically says it does a sort of series of checks again on things like, for example, here are the positions the broker thinks you have. Here are the positions you think you have. Are they the same? Again, if they're not the same, then something's gone wrong. Most likely is because I'm trading futures, is that a futures contract I own has expired and I need to shift from one to the other. So that's about maybe 45 seconds in total. And then periodically, say once a week, I need to roll into a new futures contract. That's maybe about 5 minutes in total. And so, yeah, so it's probably less than 10 minutes a week, to be honest, most of the time. If something does go wrong, and very occasionally it does. But I've been using my code for a long time now, so most of the bugs in the system have pretty much worked out now, fortunately. Then there could be more. If I'm doing some kind of research into improving my system, obviously that will take longer. But a lot of the research I do doesn't have any impact on my system anyway. I tend to make very few changes to my trading system. So, in terms of direct research I do on my system, it's going to be hours a year, if that. So yeah, not very much at all.
And what happens when you go on vacation or you get sick? Do you need to frantically just close positions, or you can just your systematic approach handle your absence?
Well, getting sick is kind of irrelevant, right? Because and actually the issue I have is so basically the risk is because I run my system locally, not on the cloud. If, say, I have a power cut or the internet goes off, if I was sick, that would get fixed because my daughter would complain that the Wi-Fi is not working. So irrespective of how sick I was, I would be expected to fix that straight away. But if I'm on holiday, obviously I can't fix it. So there is a danger that I go on holiday and basically my system would stop trading. Now it would hold the positions it has and not close or buy new ones. So one thing I've done is I've tested my system, and I've basically tested the effect of a 1 day, a 2 day, a 3 day, a 4 day, a 1 week, a 2 week shutdown in my system, and I've had a look at the effect it has on the profitability. And the answer is almost nothing. Mm-hmm. And that's because I'm holding positions for relatively long periods of time and a very diversified portfolio. And so holding positions open and static for a few days basically has no effect. Holding them for a couple of weeks starts to have an effect, but it's very small. So I'm relatively relaxed about leaving my system running and then even potentially breaking while I'm on holiday.
You've written about many different trading approaches, and I wanted to ask you, do you maybe have some favorite trading strategy or methodology that you personally use? What does, in other words, Robert Carver's own portfolio actually look like?
I mean, in terms of my futures trading, so I've got momentum in there, which we've discussed. I've got some longer run mean reversion because, again, as we discussed, at long time periods, prices tend to mean revert rather than trend. I've got carry in there, which is sort of analogous to the idea of buying ETFs with higher dividend yields, but it's a sort of futures version of that, so it's not quite the same. I've got some other trend. I've got different trend, various kinds of ways of picking up trends, actually. And also I look at trends both at an asset class level as well as on individual markets. I look at relative trend across individual markets. That would be, how is the S&P doing versus the UK FTSE market? I've got something called skew, which basically buys assets that have recently had a really horrible day. So again, this comes down to people being bad decision makers. Essentially, if things have a really horrible day, people tend to be upset and not like that asset for a bit. So that's a good time to buy it. So that's a good sort of contrarian type of strategy. Those are the main ones, I'd say. Most of my risk allocation is in momentum or trend following, partly for historical reasons because I used to work at a fund that did that, and partly because it's the strategy that kind of risk manages itself. So if the price turns against you, it will automatically close the position, which is quite a nice property, and means I can be relatively relaxed about my risk management as well.
We are reaching slowly to the end, and if we could return to our Mr. Smith, and if you had to give him just one piece of investment advice that would serve him for life, what would it be maybe? Or maybe which of your books he should
Well, I
start?
mean, Mr. Smith should definitely read the book Smart Portfolios, which is about investing or not trading for sure. But I would say that most people lose money because they trade too often. So I would always say, and I've been guilty of this myself, actually, even though, I've written books about it. So I would say the one piece of advice I would give to Mr. Smith is, if you're about to do a trade, stop and think. And just go through all the reasons for doing it again and make sure you're doing the right thing. Because once you've done it, it's irrevocable. And if you need to reverse it and reverse it in some way, you're going to need to trade again, which will cost you money, which is just a waste of money. So yeah, stop and think twice before trading would be my one piece of advice.
All right. Rob, this has been really fascinating from, this practical investment advice for beginners and also just a little bit of behind the scene of how you're doing systematic trading. So I want to personally thank you for your time and your generosity in sharing your knowledge today. And where can people find more of your work and continue learning about both, the smart portfolios and maybe systematic trading approaches?
The best single place to go to is systematicmoney.org, which is my website. And there's links to my blog, and you can get links to buy my various books as well. And there's also links to all of my social media, so my Twitter, X, Facebook, etc.
Okay, so I will put all the links in the show notes. So once again, Rob, thank you so much for joining us on ETF Atlas. And this has been really incredibly valuable conversation. And to our listeners, thank you for tuning in. Remember that on our portal, we host the world's largest ETF database covering ETFs from United States, Canada, and Europe. So basically, I could say that if you can't find an ETF on our platform, probably it hasn't been invented yet. So until next time, this is Jack Lampard for ETF Atlas. Keep investing and remember, smart, keep it simple, and remember, boring can be beautiful when it comes to building long-term wealth. Thank you so much, Rob.
Anytime. And if I could say one more thing, it's that Mrs. Smith, as well as Mr. Smith, is very welcome to visit my site and read my books, as are Miss Smith and Master Smith, of course.
All right, great. Thank you. Bye-bye.
Thank you.